So you have taken the leap. You have registered your business with the BIR, gotten your authority to print, and now here you are. It's go time. But before you can celebrate your new venture, you need to make sure that the backbone of your business is solid. So today we're diving into something fundamental and often overlooked. So how to set up your first ledger and chart of accounts. Well, it's not really glamorous, it's not shiny or flashy, but this is how you build the foundation of everything to come. So hi, I'm Dennis Hilario, and I help business owners just like you navigate the world of business, finance, accounting, and all the things that keep your venture running smoothly. If you're here to learn practical business tips to grow your business, you are in the right place. And if that sounds like something you'd be into, go ahead and hit that like button and subscribe. You don't want to miss what's coming next. So let's try to cut through the noise. Chart of accounts is not complicated. It's simply a way of categorizing all the moving parts of your business: the assets, liabilities, equity, income, and expenses. That's all it is. Each of these are buckets, stories that every single transaction falls into. And whether you are scribbling in a notebook or using a spreadsheet, this is the starting point for every financial move you make. Now, the secret here is simplicity. You can start with broad categories, and as you learn more about your business, break those down into sub-accounts that make sense. For example, under assets, you could have cash, cash in bank, or bank accounts, accounts receivable, inventory, and so on. This structure lets you clearly see where your money is going and coming from. So below this video is a sample standard chart of accounts list for your reference. So you will need your general ledger and journal ledger book of accounts to do these transactions. These are required by the BIR. But you have an option to have a copy in a Google spreadsheet or an accounting software, which I will discuss in my future videos. So the two book of accounts that I mentioned are not limited to that. There is still purchase book, sales journal, and so on and so forth. Again, we'll discuss that in the future videos. The key point here is how to start using your ledger if you're a starting company or if you're an operating company who wants to be fully compliant, or if you are an operating company who wants to make it right. Alright, so every business has its beginning. It often starts with one transaction, which is your initial capital, the money you put in to get things going. Maybe it's 100,000 into your business bank account, or it's just cash you set aside in an envelope. So let's break this down in accounting terms. To record that initial deposit, you have to debit your bank account or cash because that's your asset going up. And then the credit is your equity or capital stock to show the ownership or interest in business. The magic here is balance. Every debit has a credit, every action has a reaction. Let's add a little detail to make this clearer with a real world example. Let's say on October 10, you open a business bank account and deposit 100,000. Your source document for this entry might be the bank deposit slip with a reference number for tracking. So here's how the ledger will look. So in your journal ledger, you record the transaction date, the reference number, which is the deposit slip, and then the debit is your bank account in your chart of accounts, and then the debit amount is 100,000. Now in the next row is the same information, except that the credit account is equity or capital stock, and then the credit amount is 100,000. So the debit increases your bank account balance and the credit represents the equity you have put in. It's all about tracking where the money came from and where it is going. So that's the record in your journal book or journal ledger. Now in your general ledger, you have to have a separate record that shows the beginning balance of your cash in bank, which is 100,000. And then another page where you record the equity, the increase in equity, which is again 100,000. I know it's difficult to visualize this, especially if you are listening this via my podcast channel. But if you want to see the visuals, you can check out my Accounting Starter digital course in the description box below. Alright, so another scenario is that what if you have already done some spending before you officially open your doors? Maybe you bought equipment, paid rent, or took care of licenses. So these are pre-operating transactions. So these pre-operating transactions matter just as much as any future transaction because they represent your investment and commitment. So let's say you spent 20,000 pesos on a laptop and 5,000 pesos on licensing fees before launching. So you would record this as follows in your journal ledger. Again, put in the date, the reference number of the source document. It can be an invoice number from the supplier or a billing statement or billing invoice from your lessor. So the debit entry here are the equipment laptop, which is 20,000 pesos, and the licensing fees, which is an expense of 5,000 pesos. And then the credit would be your cash, which represents 25,000 pesos in amount. So here we are debiting equipment and licensing fees on assets because they add value to your business, and we credit cash because that's the resource you have used to pay for them. So it's all about making sure every penny is accounted for and categorized properly. So very quick, I'd like to discuss a quick notation about debits and credit. So increase in assets and expense is usually recorded as debit, and decrease in asset and expenses are credit. Now increase in revenue, equity, or liability are recorded as credit, while the decrease of those accounts are recorded under debit. So the journal ledger is just showing the transaction, and then the ledger is the representation of each account. So we have an increase in the equipment, like the laptop. So it should show the running balance of that, which is 20,000 pesos. And then we had either asset or expense, which is the payment for rent. Then it's represented as an increase in rent. So there should be a record, the running balance of 5,000 as of that date. And then a credit to your cash, which is, a decrease in the running balance of your cash. So think of it as a bank statement. And so in the bank statement is similar to the general ledger of the company. So it shows the increase of the balance of a specific account like cash or equipment and whatnot. And the rightmost column is the running balance. So now, what if your business has been running already for a while? So you're already making sales, paying bills, and you're only now setting up your ledger. So how do you make sense of it? So don't worry, it's just a matter of catching up. So you'll need to take stock of all your current balances as of the date you start tracking. Think of it like a snapshot of your business on that day. So for example, as of September 30 or end of the month last month, list all your assets, the bank balances, inventory, and receivables, and equipment. Then list also all your liabilities. So the bills due, the loans, and the credit balances. Then calculate your equity, so owner's equity and any retained earnings. So but in the accounting equation, it's just asset less the liability. Then summarize your income and expenses. So if you're starting mid-year, include the income you have earned and expenses you've already incurred. So a quick example is that, let's say Again, it's October 1, no, and your balances are cash in bank 150,000, accounts receivable 50,000, inventory 30,000, loan payable 40,000. So your ledger entries might look like the date, which is September 30. The description or reference number, you can put like beginning balance note, and then the debit is cash in bank 150,000, AR 50,000, inventory 30,000, and then the credit would be the loan payable 40,000 and equity opening balance of 190,000. So this way, every part of your financial life is connected, accurate, and easy to read. So your business story from it start to where it is now is all right there. In my next accounting process video, I'm gonna walk you through the different book of accounts or transactional ledgers or book of accounts like purchase book, sales journal, cash disbursement journal, and cash receipts journal. So that's where you start recording your transactions after setting up the initial ledger or chart of account balances. So here's the takeaway. Setting up your ledger and chart of accounts is your first step toward understanding and controlling your business. It's not about perfection. It's just about clarity. The clearer your financial picture, the better decisions you can make. And if this feels like a lot, so that's okay. Starting a business is one step at a time. If you need help or have questions, drop a comment below. So don't forget to hit like, subscribe, and share this video with a friend who needs it. So download my free chart of accounts template in the description below. Keep building, keep growing, and I'll see you in the next video. DX Your Life and Business. Have a great day.